Hello, this is Richard C. Wilson, founder of the Family Office Club. We have with us today Jose, and apologize if I said your last name wrong right there, but welcome Jose to the interview.
Hi, my name is Jose.
Great, and this is an investor mandate interview, so we're going to be talking about what Jose and his team are looking to invest in, what they're looking for above all else. But first off, can you start with a little bit of perspective on just kind of what type of an investment firm or investor you are?
Sure. We are a multi-family office. We're located in Sioux Falls, South Dakota. We manage assets for families from around the country, but these typically have some connection to the upper Midwest, either via a trust, a business, or residence. Most of our clients are business owners or families that had a business and sold it.
Okay.
Yep.
Okay, great. And how many of your clients are doing direct investments versus traditional wealth management, stocks, bonds, mutual funds, ETFs, et cetera? How many of them are actually going direct at independent sponsors or real estate deals and buying companies, et cetera?
Yeah, all of our larger clients and families invest directly and through private, either direct investments or private vehicles, private real estate and private equity funds. We manage for everyone, of course, the public equities and public bond portfolio as well. We are primarily a value strategy firm.
Okay.
We manage our own public equities portfolio, core portfolio of 25 to 30 names. We
Okay.
manage directly on the equity side. On the fixed income, we stay primarily short duration municipals. And on the high credit ratings, we take a risk on the equity side, and I think that fixed income for the most part is asymmetric risk return profile. We stay away from that. Real estate is an important part of our portfolio.
Okay.
In our case, as of today, more so than private equity.
Okay.
We invest for our clients in a variety of ways in real estate through direct investments, through funds that are mostly private and private REITs and private smaller funds.
Okay, sure. And what are the best ways that you are able to source good investment opportunities on the direct side or on the fund side for your clients? Is it usually through one or two platforms you plug into, and it's really hard to get an investment, with a multifamily office like yourself, unless you're on one or two of these platforms, or how does that usually look?
So for the private, on the private side, it's really our network, right? It's who we know.
Okay.
Especially we want to go direct. We like to invest with people that we know. Either we know the developer, if it's real estate, or we know the property manager, or we know the asset, right?
Mm-hmm.
So those are one of those, and if you know the three, even better. In practical terms, that limits your geography as well. It's hard to know what's going on everywhere in the country or even internationally. So in our case, even though we can look around the country, we're more inclined to work within our geography, which is the upper Midwest, like in Minnesota, Nebraska, Iowa, the Dakotas, and some of the western states up to Colorado.
Okay.
And Missouri. So that's kind of our geography. It makes sense that we'll know better the developers, the managers, and the assets in that region. And so how we source them is, again, our network and also going to conferences like yours. So we try to attend as many as we can of yours.
Sure.
We find a lot of value in that and really networking for deals and learning what other people are doing as well and vice versa. So, yeah.
Sure. So, one interesting thing right now is that in people who are looking at real estate deals, some of the closings are delayed. Sometimes people question the valuation. It's hard to get somebody to go on site to inspect it when you're trying to close on a deal right now. Some lenders have pulled lending on some deals in some areas that they think are questionable. So answering this next question, maybe it might need to have two-part answers from you of what's the number one type of investment you're really looking for. Asking that right now at the height of the virus crisis. You might be listening to this once this is over. So I'd like to also have you answer it how you would normally answer it if there wasn't a virus crisis. But, I know right now a lot of firms are looking for things that are doing well despite the crisis, or looking for alternative investment strategies like life settlements or something that's really different than the stock market or real estate and could still do well despite right now. But how do you talk about that internally as a team in terms of what you're sourcing short term versus, let's say when this goes past us, hopefully in however many months, what you'd normally be seeking.
Sure. So before this happened, we were really focused on opportunity zone investing.
Okay.
And we were in the process of, and still are in the process of identifying some real estate projects that we like in the opportunity zone. We are also trying to invest through impact. Impact is a word that can mean many things, but in our case, trying to really have a quantifiable and identifiable social benefit in our case. And the whole OZ legislation is geared towards but as you can invest in an opportunity zone and have a very limited real impact. So we want to do both and use the opportunity zone to really do impact investing. We're still doing that. What we think has happened now is that we believe real estate across the board has been repriced, even though you're not seeing it in the private market. De facto, it has. You can't have the public markets do what they've done and not have a comparable repricing on the private side. So what that means is the hurdle rates for any kind of real estate project is going to be higher because you have a much higher expected returns on the public side and on existing properties. So for a new build, the hurdle is higher, and and that means that a project that would have passed the test a month ago, well, it has to be good on a before tax and after tax basis. So there'll be less of those. So what we're thinking is, well, maybe rather than a new build, there will be an opportunity in buying an existing property and fixing it up, or something that couldn't get completed, and then get on with that rather than a from scratch ground up build on the real estate side. We also are focusing on private equity in opportunity zones. We think that the OZ legislation really is ideal for private equity, even more so than real estate. A lot of it has been real estate driven, but private equity is the real way to benefit from that. We think there'll be more opportunities of that, and we're trying to be creative and also partner with people that are thinking that way and identify good opportunities in that space.
Yeah, I'm glad you brought that up. I think maybe only 2 out of 100 people I know of that have talked about opportunity zones to me, have talked about the private equity side about it at all. And so I'd love to see some people do a lot in that area, just because the legislation seems wide open to both types, but everybody just went hard on the real estate side, and the private equity side seems to be kind of ignoring or downplaying it. So that's something I think we could bring up.
As a matter of fact, earlier this week, I was in touch with someone I met at your Miami Summit conference who has a private equity deal opportunity zone, and they're think of relocating to our area. So we're talking to them about that.
Great. Yeah, that's great. Yeah, and I think that sometimes it's trading ideas like that between peers, between investors at our events will just help you go down a different research path. And sometimes it's a very specific investment opportunity. And then sometimes it's like a structure, like a way to structure a deal, or a bonus depreciation type idea that you hadn't asked your accounting firm about. And then once you ask, they're like, oh yeah, we have an expert on that. And it turns out you can save money on every deal you're doing. So that's what kind of keeps it interesting for us hosting the events. We're always learning more. So I appreciate you bringing that up. You've been to some of ours in the past. And once we've gotten past the virus stuff, we'll have you back at one of them, I hope, soon.
Yeah.
And we hope to see you on one of the virtual investor discussion panels coming up soon as well. And, our last question for this interview, though, is about your number one piece of advice, your $100,000 piece of advice for an investor listening here. You've already kind of given some insights and, some things that probably people overlook related to opportunity zones, but what would be your number one piece of advice?
Yeah, I have the two that I thought of, and one may be obvious, and I would think that most of your audience has already implemented this by now, but if not, I'll just mention it just in case. I think large investors, anyone that has more than 30 million in public equities, should have by now transitioned into an ETF or a direct stocks. The cost of holding and managing direct stocks is zero or close to zero now. So you can save $100,000 by moving 35 million out of an actively managed 1940 Act fund into an ETF or a portfolio of individual companies. So that, again, I think most people that have a portfolio of 50 million in public equities should have done that by now, but I'm guessing not everyone has. So it's something that should be an easy implementation.
Right. Yeah, sure. I appreciate you bringing that up.
And then on the private side, I think that often investors in real estate are going to single property deals with by a friend, a promoter that they know. I think what happens is that people tend to underestimate the risk and overestimate the return. And I think unless you're very close to one of the parties, the developer or the construction firm or the manager, or you know the asset, you're going to underestimate the risk and overestimate the return. You're better off going into a private fund of some sort that you're diversified. That in the end you'll pay the price.
Right. Yeah, it's interesting. I mean, I think that's again something that we could dig into more on one of these panels, because I'd love to ask you like 2 or 3 questions about that and talk about it and add more value to listeners, because I just know that especially when people try to go direct into multiple asset classes all by themselves as a little 2 or 3 person team, and they're going into operating businesses as well as retail, as well as warehouses, as well as multifamily. It's like there's so many learning curves they're trying to move up at once that you're in trouble basically. You're throwing darts.
As an LP, small player, you don't know what you're getting into, and so you'll pay the price.
Yeah, exactly. Yeah, I couldn't agree more. Awesome. Well, I appreciate you sharing your advice and insights today. What's the best way for someone to get a hold of you? Is it through LinkedIn or email or?
LinkedIn, email, jose@elgathon.com. Phone number, call me direct on my cell phone. LinkedIn, always happy to talk to anyone.
Great. Yeah. And if anyone's listening to this and needs to get a hold of anyone on the investor mandate interviews, as long as you're a member, then you just speak to Jennifer on our team or anyone on our team, and we'll help get you connected to some of these investors. So thanks again for your time, Jose, and we'll be in touch soon, and hopefully see you on a panel here soon as well.
Thank you for your time. Good talking to you. Bye.
Take care.